want to bring in Reid Morrison now, Global Energy Advisory and U.S. Energy and Chemicals Leader at PwC. Reid, good to have you here. So you've seen the run up in oil prices. Do we have further to run up, do you think?
It depends on the timeline you're looking at. If you're looking at the next 30 days or even the next 6 to 9 months, I think we're pretty range bound. If you get beyond 3 years, then I think you've got a lot of volatility that's going to come into play.
Whether or not oil stays above $40 a barrel, I guess depends a lot on what OPEC decides next week about curtailing future production. What are your thoughts there?
OPEC is really focused on maintaining market share, but they also want to have the price be more in the $60 range. So they're having to balance their own spare capacity, what the demand is right now, and then being able to slowly bring back that supply that matches demand and doesn't tank the prices. And so you're going to see them continue to maintain some constraint, but also looking for the green shoots of a recovery so they can participate in the upside, but also protect their market share.
Jared Blickery here. So we got the OPEC plus side. What about the U.S. side, where we've just seen decimation in the Permian Basin? Oil rig counts, I think they've settled somewhere around about 150 there. As the price rises, of course, some of this might come back online unless we are seeing a new paradigm, a new strategy. For instance, what happens and what's your prediction for the Permian specifically as oil prices rise?
The way companies used to be valued was on the size of their reserve base, a net asset value, and you saw the equity prices where it would get rewarded. That's no longer the game. Now it's about returns and it's going to be about dividends. So what you're seeing is the Permian players and a lot of the US independents, they're largely backing off their exploration, which is the growth side of it. And they're just going to harvest what they have. So if that means from an investor standpoint, it's going to be pretty good, actually. They're coming out with fixed plus variable dividends. They're all making commitments. Any additional free cash flow goes back to increasing dividends, share buybacks. That all sounds really good. And from an investor standpoint, it's going to be kind of the roaring 20s. But what's going to happen is you're going to see the shortage of supply in 3 to 4 years, and everyone's going to be like, where's the next barrel? Well, the exploration department was shut down. The rigs were laid down. And it takes 3 to 4 years to get that next barrel actually out of the ground. And we'll have that as a consequence. But right now we're in a supply excess and demand is so low that people aren't really wanting to place any bets right now.
Reid, what about the resurgence of COVID-19 in Europe and the US? There are some predictions it's going to hurt oil demand by as much as 3 million barrels a day, but will it stop oil prices, you think, from rebounding over the next 12 to 18 months?
The amount of demand that's been displaced has already been factored in, and whether there's a second wave of infections or just the whole lockdown, there's not a lot of demand that can disappear because, as you've seen, we're all working virtually and something's powering the grid. And as much as we all want to have clean energy, it is largely the hydrocarbons that are the base load. I think everyone in the industry knows there's an emissions challenge that we have to tackle ourselves. But when you get into the good old fashioned, where's the energy come from? You've got this base load coming from the hydrocarbon. And so as the demand has shrunk in normal manufacturing and consumer, there's been an increase in electrical demand. And a lot of that has been fueled by the natural gas plants that are out there. And that's where you can see the base case for the demand. We kind of already hit the bottom, and it may be some seesawing back and forth, but it's not going to be that crater that's going to take prices way down.
Well, I'm glad you mentioned emissions because we're seeing some big changes at some of the majors and larger energy firms. We just learned today that Occidental Petroleum, they're targeting by 2040 a 1-2 net zero, and then by 2050, 1-2-3 net zero. I'm just wondering how this affects the plans of the majors, which already had to pivot a lot. Is this going to draw down future potential profitability? What's your assessment of this?
When you look at the election and also the whole emissions thing, one of the things that the industry has really been fighting for is, can we just have a rational conversation with people that are all invested in trying to solve the problem? And there's always goodness that comes with a change in administration because you got some fresh eyes to look at it and it's no longer adversarial. I think the industry has taken its medicine that has been labeled a bad actor around emissions, and it kind of has earned that reputation. The really cool part about it is the emissions problem is solvable. What's not solvable is having a energy source that you can store and transport at will. And the really cool thing is, as much as people call it fossil fuel, I've had a couple of my CEO friends and alternative energy companies say the only thing they're trying to do is reverse engineer what Mother Nature created, which is an organic device to store solar power. That's what a hydrocarbon is. Its base chemistry came from algae and photosynthesis. So when you get into that and you ask the emissions problem, this is one of those things that actually scientifically is solvable. You can capture every particle that comes out of a tailpipe or refinery, and the studies going on these days, you can reuse it. Now it's going to take capital to do that. And that's where I see the collaboration and cooperation between the different government agencies and the industry has a chance to move to a different, more constructive type of conversation.
All right, we're going to leave it there. Reid Morrison of PwC, thanks for being with us today.
Appreciate it.